Hello and welcome to today's Market Matters video update. I'm Harry Watt, joined by James Garish. It is midway through June, so we're going to wrap up May's performance and how equity markets did more broadly, James. So May itself was a positive month for equity markets globally. Here in Australia, we probably underperformed a little bit, but we still were higher. What's your sort of read into why we sort of lagged a little bit last month?
Yeah, it was the Silly May call didn't play out, that jingle that gets so much airtime. It doesn't have a lot of statistical significance behind it. Positive month, ASX up nearly 1%. It was up 92 basis points. So reasonable period if you look at that in isolation. But as you made mention of, US markets were a lot stronger than ours. So they had underperformed the prior month. So they bounced back on the back of strong performance from technology stocks, and that was the leading sector here locally as well. So S&P 500 was up 5%. If you translate that back into Aussie dollar terms, the Aussie dollar was higher. So international equity returns in Aussie dollar, from an Aussie dollar perspective, didn't achieve the 5%. But look, a positive month. Commodities were probably an area that lagged. They weighed on our portfolios a little bit during the month. And as I said before, technology was the sector to be in, and the US market is filled with tech, and we're not. So that speaks to the relative variance in performance.
All right, given that backdrop, James, our flagship active growth portfolio, how did that fare in May?
Yeah, reasonable month, just in line with the market. So up 91 basis points. The market was up 92 basis points. If I look on a 1 year view, it's up nearly 18.5%. So we've had a good year, and all key time frames, as you'll see on the screen in front of you, is performing strongly. We have a lot of the, outperformance in the last 6 months or so has come from an overweight bet in commodities. So that started to detract from our performance at the back end of May, and it's also detracting from our performance in June. So expect a little bit of weakness, depending what plays out in the final 2 weeks of June, coming from that overweight commodity position in the active growth portfolio. So all in all, the timeframes performance continues to stack up, and we just continue with our normal process around how we position in that portfolio, how we approach markets on a daily basis. And we know the macro backdrop continues to be key. But at the end of the day, that stock picking is where the rubber hits the road. So we do focus a lot on individual stock picking within that portfolio.
All right, on the income side of things, it was probably a tougher month from that perspective. It wasn't an area of the market that did well, broadly speaking, but how did our active income portfolio go, James?
It's been a bit of a struggle. So it was down mildly in the month. The active income portfolio has actually had a pretty tough 12 months, relatively speaking. So it's up on a 1 year view, it's up over 7%. But we're a little bit disappointed with the returns coming out of that portfolio in the shorter time period. So I'd call out a couple of things. So probably being a little bit too conservative. So we've got some positions in there. A government bond position, a bond ETF in there, they're lower risk positions, but they're not capturing the income that you could capture from, spicier income investments on the ASX. So whether that be funds exposed to private credit or broader fixed income funds, etc., that are targeting a higher return. So obviously that comes with risk. So this is a low risk portfolio, low volatility, consistency in returns, and it's delivered that over the longer time periods that you'll see on the screen there. But from a shorter time perspective, we've struggled from a relative sense in the last couple of months in this portfolio.
All right, the last local domestic focused portfolio is the emerging companies portfolio. Obviously, if you're talking spicy, that's the spiciest of the lot. And how's that one going in May, James?
Yeah, targets emerging growth companies listed on the ASX. Had a tough start to life. Launched just before COVID, so we've sort of been chasing our tail ever since that. But the numbers more recently have been really strong. So the month of May saw that portfolio up over 1%. The Small Ords Accumulation Index was actually down in the month. So that was some strong outperformance, relatively speaking, in that portfolio for the month. And if I look on a 12-month view, it's up 18.5%. So which is about 8% above its benchmark. So we're getting some runs on the board in terms of the emerging companies portfolio. in more recent times, and that's working its way through those longer term performance numbers that you can see there. So there's always going to be hits and misses. So you could jump on the website and you'll see some big variances in stock returns. That's always going to be the case in this portfolio. That's something to keep in mind. It is a high risk portfolio. It's one that's targeting growth in smaller companies, so higher volatility, potentially higher returns over time. But you need to have a longer term view around that portfolio, Harry.
Yeah, certainly. If we move international, our international equities portfolio, very much a US focused portfolio. We've heard about how the backdrop was there, and potentially the impact of the Aussie dollar on that portfolio as well. James, how has that played out in performance in May?
It is a US-centric portfolio, but a lot of the companies that we own that are listed in the US have global businesses. So they're generating a lot of their revenue and earnings, etc., from all parts of the world. So it is a portfolio that did really well in the month. So it was up nearly 6% on the month, and that's even considering bringing it back into Aussie dollar terms. So that takes into consideration the strength of the Aussie dollar. So I think the Aussie dollar detracted about 1% from returns. So you take out the influence of currency, so price it in US dollar terms, and it did around 7%. There were a few really strong positions in that. First Solar was a company we've held for about 12 months or so, but then exploded during the month. And was up sort of 40-50% in that time period. So there's some interesting stocks in there. I like that portfolio. It's more tilted towards the growthier. It's obviously got technology in there, but it's got a lot of other broader thematics that you can only get exposure to in the US. So broader time frames, it's up 24% over the past year, above its benchmark in all key time frames. So continue to back that portfolio. We've been speaking about launching this portfolio as a investable portfolio for too long now. We were launching it about 6 months ago. However, there's some positive developments that I don't want to put a time frame on it, but there'll be an opportunity to invest in this portfolio in the not too distant future. So keep that one on your radar.
All right, our last portfolio and our newest one to the stable. It's now starting to get more than 12 months sort of time frames on returns there. The core ETF portfolio focuses a little bit more on macro and portfolio positioning from a more general sense, I'd say. Yeah. How did that one go last month and sort of since inception as well?
Yeah, so we describe this as sort of a traditional balanced approach, but within a dynamic asset allocation framework. Bit of a mouthful there, but essentially it means that we do the asset. We hold a broad spectrum of assets, so from Aussie equities, international equities, to fixed income, to alternative assets, to property, and the like. So this is could be used as sort of a core basis for a well-diversified portfolio, if you like. Low-cost ETFs, not as active as our other portfolios. It is performing well. It's going to be lower volatility. It's going to be lower return. It's going to be less activity and less to do in that portfolio. So it was up 0.5% in the month. Is up 9.88% over the last 12 months, above its benchmark by about 2.6%. And inception, it was launched in April of 23. So we're building on performance data. We always like to have longer term performance data in our portfolios. So the longer time frames around performance, the better. So we know this is still relatively new, but it's doing what it should do. It's doing what it says it should do on the tin, Harry, which is what we're all about at Market Matters.
A few runs on the board early in that one. So talking more now to stock-specific stuff and market-specific trends we're seeing. I think this is what we do day to day. This is what we're known for. On a volatility side of things, stock-specific volatility certainly ratcheted up, and in between sectors as well. Like sector variance has been pretty significant over the last little while. Are we seeing that continue to play out into FY25, James? What are we expecting that to sort of pick up and maybe see a bit more volatility on the index level as well?
Yeah, so I mean, volatility on the index has been pretty benign. So, the market in Australia has just been trading in a sideways trending range for quite a while. The US market continues to make all-time highs. I think Last night it was the fourth night in a row in the US, all-time high in the S&P 500. It's done that 29 times this year so far. Our market is lagging a little bit. There's obviously reasons for that. When you think about our market in accumulation terms, so inclusive of dividends, is making all-time highs. So things are going well in equities from a broad sense. I think we're top-down, bottom-up investors. So the macro is something we take put a fair amount of effort into understanding. But again, as I said before, the rubber hits the road on stock selection. In the from a macro perspective, there's this, indecision around what interest rates are going to do. Will they be cut? When will they be cut? Etc. We firmly think interest rates will come down. We're more in the camp that this year we'll see more cuts than expected in the US. That's going to be supportive of equities, but also some sectors in the equity market. So, an area we like at the moment is property, for instance, on the back of that. National Storage REIT is a company we've got in 2 portfolios. We like consumer discretionary stocks. So consumer discretionary stocks pull back pretty aggressively on the back of rising bond yields last month. That's presenting an opportunity. JB Hi-Fi is one of those. Super Retail is another one. The commodity landscape continues to be volatile. We've had a huge run in copper, and now we've had a pullback. So a lot of these copper stocks are down 10 to 15%. Sandfire would be, we've accumulated that this week. We think that's a good bet. Paladin in the uranium space is our preferred pick there. So we've bought back into Paladin and continue to accumulate it into weakness. But we like Deep Yellow, we wrote about this morning, and others in that space. Peninsula in the smaller, 300 million market cap space. So I think this volatility will continue. I think it will continue to throw up opportunities for active investors. Commodities are cyclical. We're getting a reminder of that at the moment, but we're still backing that thematic, which is underpinned by this huge runway of global decarbonisation. So that is pretty much sums up how we're thinking about markets and how we'll continue to position our portfolios into the back end of FY24 and into 25.
All right, that's all we've got time for today. It's good to have a decent May in the books from a portfolio standpoint, and I hope you got a few snippets out of this video to take home with you and put to work in the markets there.
Make some money, Harry. That's what we're all about.
Make some money, keep digging higher. So thanks for joining us, and as always, keep an eye out for our Market Matters reports.